Welcome everyone to our second installment of our quarterly panel for 2023. My name is Richard Mansfield. I'm the Chief Financial Officer and Chief Operating Officer for Seubert and Associates. Today, we're going to be evaluating risk from a financial perspective. We brought together some of our senior leadership from the Seubert team to discuss the financial impact a risk management program can have on clients' business. So today we have with us Will Chapman to my right, Senior Vice President of our Surety Bonding Division. To his right, we have Eric Rheam, Vice President of Benefit Operations. And lastly, we have Joe Calco, who's Vice President of our Commercial Alliance Department and Chief Risk Officer for Seubert. So today we're going to start off with a brief overview from our panelists about how each of their individual insurance operation teams provide advisory services to our clients, specifically relating to working with our clients' internal financial service teams and their executives, and how they should consider in balancing the financial implications of managing overall insurance risk within the context of also managing the ongoing financial strength and profitability of the business to ensure it continues on a path of growth and continued opportunities for its employees and its customers, while continuing to minimize risk to the overall organization. With that, we'll lead off with Will with his opening comments.
Thanks, Rich. And first of all, I'm happy to join Joe and Eric on the panel. After learning that the first panel was put on YouTube, my kids started treating me like a superstar. So that's been terrific. This topic, evaluating risk from a financial perspective, sounds like it came right from a job description of a surety underwriter. It is one of the basic and most important functions in evaluating contractors that are requesting surety credit. Contract surety underwriting can be simplified into what we call the 3 C's of suretyship: character, capacity, and capital. While all 3 are important, the third C, capital, which is essentially evaluating risk from a financial perspective, is what tends to drive a contractor's surety capacity, rates, and terms. The surety's focus will mostly be on corporate financial analysis, job schedule analysis, and personal financial statement analysis. For larger and/or well-capitalized companies, personal guarantees may not be required. In those cases, the focus will be solely on corporate financials and job schedules. Some of the main financial drivers that will provide comfort to sureties and allow them to provide aggressive terms include consistent profitability, debt to equity less than 1.5 to 1, stronger than needed working capital and equity as evaluated in relation to the backlog and the total surety credit desired. A clean balance sheet with a favorable composition. For example, $2 million of cash will always be treated more favorably and aggressively than $2 million in underbillings or unapproved change orders. Strong banking support with consistent bank line availability, excellent history of profitable projects, and consistent profit trends on both open and closed jobs. Where applicable, strong personal balance sheet strength and liquidity. The barometer or baseline for support will be based on the fiscal year and CPA reviewed or audited financial statement. The surety will rely on the unbiased third-party opinion of the CPA. It's very important that the accountant has a construction expertise who verifies the numbers and challenges your estimates. We commonly see small and medium-sized contractors run into issues due to their CPA not having the appropriate construction expertise in place. Some of the biggest financial red flags for a surety underwriter include large net losses, inconsistent profitability, debt to equity ratios greater than 3 to 1, low levels of working capital relative to backlog and surety needs, collection and change order issues, unusually large underbillings, consistent high usage of the bank line debt. Unlike insurance, the surety industry does not expect any losses and underwrites to a 0% loss ratio. By nature, this makes the underwriting process comprehensive and conservative. If financial issues do arise, it can make it very difficult to obtain bonds. Terms and conditions can change drastically, making it hard to obtain the levels needed. These contractors can also experience higher rates and sometimes the need for more indemnity or guarantees, In extreme cases, non-standard approaches such as funds control and collateral may be needed. Obviously, maintaining financial strength is vital for a contractor and its ability to obtain surety credit.
Okay, thanks, Will. I appreciate that. Next, we'll move to Eric and an overview of the benefits, operations, and financial risk
Sure.
consideration.
Thanks, Rich. I think the premise of group benefit purchasing is to be proactive and creative. And like as an employer and purchaser of healthcare, like our client teams and our clients it's really important to understand like what you're paying for, what you're getting out of it, decisions you make on your benefits, and like how you quantify those decisions on the back end. We manage a lot of different clients here, and they're all unique in a certain way. There's various different ways employers can finance healthcare, the different carrier and vendor partners that they have. And whatever we do as a client team, it's very important that we proactively get in front of these different options that are available to them. So I think for the most part, when we're working with our clients, we're working to make calculated and quantifiable decisions so they could ultimately communicate those effectively to their assets or their employees. So I think whether you're a contractor with 50 employees or a large manufacturer with 2,000 employees, I think like the commonality in all this is just proactively understanding the specific options, the financial outcome of those options, and then really making a plan for how you execute on those different initiatives. So when our client team and our financial team and our clients are engaged and understand the implications of decisions and what that really means, like these pitfalls and risk can be more proactively managed. So no one likes surprises. And like, I think one instrument that we use to work with our clients is just written down, agreed upon service plan so that these risk strategies that we have in place can be more managed and surprises are avoided. So like in summary, I think our client teams are passionately understanding and working with our clients on all these different options, including financial executives at our clients, and really work towards like early identification. So we're minimizing these emerging risks that are inevitable in healthcare. And again, they're all specific to each employer. So I think just being creative and proactive, because every situation is unique, is something that our client teams pride themselves on when working with each of our employers.
Thank you very much, Eric. With that said, with these overviews, we're going to come back to Will and to Eric and have a few drill down some questions. But first, we'll have a brief overview from Jeff.
Thanks, Rich. So as we talk about the commercial line side, we're really talking about a very broad landscape of risk for our customers. This is their people, places, and things, workers' compensation, and how individuals are in the workplace and doing their jobs, and then taking into consideration all the additional strains and stresses that are put on people in society today. It's creating uncontrolled risk that unfolds in people's workplaces. So, when we talk about broad areas of risk, people, places, and things, it makes it difficult for organizations to control. And oftentimes they put their efforts towards the area where there's pain, where there's noise, and they see their insurance costs continuing to increase. But to Eric's point, proactivity is the same approach in our world as well. Organizations that anticipate what can happen to them can really begin to insulate themselves from the market conditions that we're all subject to. And as we drill down further and talk about the broad landscape of risk that organizations are facing today, it's their vehicles moving down the road, it's their computer systems, it's their physical property, and then, working through the challenges of their operations, and then having the additional strain of the insurance marketplace, pushing down on them on top of rising and inflationary issues over the last few years. It's really made the insurance discussion combative at times, where individuals feel like they're being taken advantage of by the insurance marketplace. But the harsh reality for us is the last few years have been really catastrophic. We've had significant natural disasters that have just, wreaked havoc on these insurers' reserves, and where their financial stability has been relatively sound over the last decade, we saw losses. And 2022 ended pretty harsh for us on the commercial side of insurance. And we posted 102 combined ratio, where in our world, that combined ratio, anything over 100 means those insurance companies posted a loss. No one's singing the blues or crying, a river for these insurance carriers. But the reality of it is there were losses, and the underwriting, whether it's done inaccurately or it was just not anticipating the magnitude of the events that we were going to come up against, there's been a hard recoiling in an already, hard market where insurance prices continue to rise. And, we find that most individuals are allowing insurance to happen to them instead of taking an active role in actually controlling what's going on. The juice is always worth the squeeze from a risk management aspect. If we can convince insurers that you're a good risk and demonstrate control, there's a lot more latitude when it comes down to their pricing models. They're, providing good insureds with, rewards and opportunities to kind of part the curtain and say, if I do this, could I get this type of return on that investment from my insurance program? So if we continue to take a proactive approach, eyes wide open, looking at what's coming down the road for the next few years, it's going to be some time, maybe 2, 3, before we really see rates ease to the point where people can go into flat renewal cycles. The other reality is for these organizations that allow insurance to happen to them, they often want to talk about the sheer cost of it instead of looking at it as a strategic investment and working with a broker that understands their industries, construction, real estate, healthcare, transportation, and the nuances that come along with that can prepare them for the losses they will experience and actually get ahead of those. And the name of the game is still the same as it's been for the last 30 years. You ultimately pay for your losses. So if you as an organization can build systems and practices to prevent those from happening, you're going to naturally be able to weather the external factors that are affecting so many people and be able to do it in a much more strategic position because you looked at insurance as an investment rather than a cost. So that's where we're seeing more of our insureds weathering what's happening because their losses are in control, and the things that are out of their control are less of an impact to them because they're not getting hit twice.
Right. Thank you very much, Joe. Appreciate that. We'll come back to you with some further questions. I'm going to now turn to Will. Will, you spoke about 3 C's and certain financial criteria that are much important when underwriting for surety bonds. What are areas contractors can focus on to help mitigate their particular financial risk for their business?
Sure. Yeah, some of the best practices that we see include, actually what Joe just talked about, making sure that our contractors, construction by nature is pretty risky. So making sure that they have appropriate and adequate insurance coverage, that's very important in mitigating financial risk for a construction company. Talking to Joe and his team or someone like that, having a strong financial leader is very important. Having a focus on process improvement, procedures, process, internal systems, controls, and then, finally, having meaningful relationships with experienced business partners, bankers, insurance agents, accountants, attorneys, professional surety agents as well.
Okay, I'm a CFO for Seubert, so obviously most of these construction companies would have a financial leader like a CFO or a controller or an outsourced CFO. What are the most salient positive characteristics of a financial leader that would be successful in the construction industry?
Yeah, absolutely. Strong financial leaders, first and foremost, are empowered by senior management, executive management, ownership to make decisions, right? You don't necessarily want a bean counter. You want somebody that is empowered to, really get involved. They have excellent grips on the real-time financials. Strong focus on cash flow management. Extremely important in construction. They create formal capital expenditure plans and CapEx management. Have an understanding of equipment utilization and fleet costs. Hold weekly or bi-weekly meetings with executive leadership just to make sure they're filling everyone in and everyone's on the same page. Have a good organizational understanding of the financial impact and risks of what's going on. And I think this can be accomplished in many different ways. For smaller and medium-sized contractors that don't have the means to hire a CFO, a strong financial leader could be the owner, it could be a CFO, it could be a controller, or it could be an external partner such as a consultant or a CFO for hire.
Thank you for that. What are some of the benefits a contractor would see from partnering with a very strong surety professional like yourself or someone else on our team and getting to know the surety bonding company and carrier itself?
Yeah, absolutely. I think the biggest thing that a professional surety bond agent or broker can bring to the table is knowledge and expertise. They should have the benefit of experience and variety. As an example, I spent 18 years working for sureties and have underwritten thousands of construction companies across most of the country, including companies with annual revenues ranging from several $billion a year to less than $1 million a year. Underwritten companies that with varying ownership structures, including entrepreneurs, family-owned businesses, ESOPs, private equity, publicly traded companies. Also companies with extremely strong balance sheets that have consistent profitability to those that have had major issues or perfect storms that we've helped navigate through. So, bringing that knowledge and expertise is very important from an agent, professional surety agent perspective. It allows for trust. Your surety broker should be someone who speaks the surety's language and knows how they think. They should be someone you can trust to advocate for your business, but also have the knowledge and expertise to provide guidance and to best negotiate on your behalf. An experienced surety bond agent should have no issues providing guidance and support in all business and economic cycles.
Great. Thanks a lot, Will. I appreciate that feedback. Pivot over to Eric and some questions with respect to employer benefits. Myself as a financial executive, what kind of benefit strategies and opportunities should my company be considering as well as our client companies?
Yeah, so within our department, we live in three primary employee segments, 25 to 50, 50 to 100, and 100 and up. And I think like within each of these segments, like the options continue to evolve, right? And like as you grow, there's increased options for purchasing healthcare. So for us, like data points are king, even if you're in a smaller group segment with the demographics of a group and so forth. So the more we're able to identify with these different data points is like the more we're able to identify pointed solutions to create meaningful impact. So it's like real-time identification of emerging issues and like really setting a baseline for where we are now versus what's the outcome of this decision. So there's two things like that kind of share a commonality between most employers. It's healthcare financing in the world of pharmacy. So I'll say like healthcare financing, there's a bunch of different ways you could finance healthcare. Like, you could pay a premium, you could choose to pay your own way up to a certain limit, send individuals to an individual market. But with all this stuff, like I think it's very important that there's a very purposeful, independent, trusted evaluation done to secure optimal results for like a company's bottom line. So like specifically, Rich, like we live in a world with two integrated delivery finance systems with Highmark and UPMC AHN and UPMC Health System. Same time, we have a lot of national carriers here competing for our clients' business. And like, I think each carrier partner has unique value propositions. They certainly have different facility and provider contracts. And, it's our job to work with our financial executives on like being the matchmaker for what's going to be the best fit for our companies, for their company's bottom line. Additionally, the Consolidated Appropriations Act, there's all these increased transparency requirements on facilities and providers. So it's an additional data point that we can help analyze to find out what's really going to be the best financial outcome from a network standpoint. So like ultimately, I think with healthcare financing, we think that a company should own some layer of risk if they understand it. And it's our job to like understand how we make that impact on this medical and pharmacy trend and continue to be creative with the solutions we bring to the table. Quickly, on pharmacy, like these costs continue to rise. And like as a financial executives, there's the plan itself. So what the employees pay out of their pocket, and there's this underlying pharmacy contract. So transparency in the pharmacy world is very critical so that the contract is competitive and employees and their family members are going to the right place to get the appropriate medication. But like there's a lot of increased opportunity in that world to not only drive low net cost to employees, but also an employer's balance sheet.
Great, Eric. Along those lines, Joe. So Eric had referred to, some cost consideration strategies from evaluating and measuring the financial performance of a commercial program. Can you elaborate a little bit on the total cost of risk versus just the cost of premium itself and what that means to an organization?
Absolutely. And, we often get sticker shock. We all are in that world where, sometimes we're delivering news that isn't optimal. But, when organizations typically look at their cost of their insurance program, they're trending it year over year on what their out-of-pocket expense is on their premiums. And they often lose sight of the true cost of insurance and that investment that is made into that program. So when we look at just year over year premiums, it's sometimes one dimensional in the sense that if last year I had 100 employees and 10 vehicles and I paid $100,000 for insurance, and now this year I have 200 employees and twice as many vehicles, naturally I'm going to see an increase in my insurance. And with this being typically the second largest spend behind payroll, it gets a lot of attention, and it doesn't necessarily get the attention into the details. So we're naturally pushing our customers and the organizations we work with to broaden their landscape view of how they look at insurance and to adopt a view of total cost of risk. And total cost of risk it's looking at the premiums. We can't ignore those, but those aren't always a direct reflection of what's happening on the performance of your program because of the external factors that we've talked about, where oftentimes things are outside of your control and you're just the unfortunate recipient of these broad stroke increases. But total cost of risk kind of takes the approach of, we have our premium dollars that we write the checks for and that we spend, but it also looks how much risk you retained. I mean, if we take a deductible on and we owe the first $5,000 of every claim and we have 10 claims at $3,500, now we've increased our expenses. And we can't just look at what our flat premiums were. And the other side of total cost of risk is it's taking into consideration your taxes and fees that we pay, which are just simply the cost of doing business, but also the administrative costs that we have associated with it, claims management, incident investigations, risk and safety professionals that we have out there, personal protective equipment, employee training. There's a lot of expenses that roll up into managing risk and keeping employees safe and compliant that is often overlooked. So we have to look at those investments that we're making and seeing, are they reducing the rate that our insurance costs us versus just the total premium dollars that we pay each and every year. So, as we continue to push people to adopt a broader mindset, we have to get more people in the organization because insurance typically encompasses the CFO, the operations managers, the HR directors, the presidents, and the directors and officers of the companies, and surely the employees that are down on this level. So when we're bringing total cost of risk into the conversation, there's multiple, stakeholders that need to talk about how it impacts them and where those costs are divvied up in the organization.
Thanks, Joe. Appreciate that. Back to Eric. With some of these benefit strategies, opportunities you spoke of earlier, as a CFO or a financial executive of a business, how can one best understand the benefits decision, how they result in quantifiable results to our statement of financial position or balance sheet?
Yeah, so I think it's very important. Like, we operate with these client teams, and we have very purposeful actuarial resources and some teammates in John Forsor and Stephanie Saletti, which we truly appreciate. But with them, once decisions are made, it's really important to get on a rigid cadence to understand, outline that plan performance on a monthly or quarterly basis, which also includes predictive modeling because healthcare is seasonal, right? Mm-hmm. And with this cash flow projections that we do, our financial executives we work with truly appreciate that there's variability in these costs going to happen, especially when you start to pay in your own way. So I think most financial executives work with are really engaged in their decisions. They want to understand how those decisions matriculate and the results for the financial well-being of their company. But with those, once a decision's made, we're helping track out why they're doing it. Again, it comes back to what am I paying for and what am I going to get out of it? And that's if you're going to do something, you're going to know what it really means to my bottom line. So we have a very purposeful actuarial team that helps us kind of run through those results throughout the year.
Okay. Sorry. Joe, furthering on the total cost of risk. So everyone looks at that a little bit differently in evaluating it, specifically how that is measured. What is a realistic time frame and means to evaluate the return on the investment that we're making and on our insurance spend?
I love this question because this is where we can really kind of peel back the layers of how people look at risk. And, everyone has their own risk tolerance, what they're willing to accept, what they, actually, kind of, approach the world with every day, and then we have our risk perception of how people look at it. Too many times people say, well, it's a 1 in a million chance, without any real statistical relevance of how often these types of things can happen. And by the way, 1 in a million comes around every so often as well. So return on investment, much like total cost of risk, needs to have a broadened view, and we need to understand all the people that are affected by the investments we make. So I was fortunate earlier in my career as a safety director to always be in the position where I was asking for money, right? Because safety is very commonly underfunded, and especially was 20 years ago when I first started. But I got in the habit of asking the CFO, your counterparts all the time, and it was my hand was out. It's like, you're always asking me for something. And I learned very quickly that I needed to paint a very vivid picture of where return on investment meant for our organization. So I would understand who was benefited, who was impacted by the decisions and the investments we made, and I would try to drill down into where those benefits actually stacked up. And oftentimes, from a financial perspective, that's what we're looking at. I spend $10,000. What's my expected return on that investment? It's going to save me 100 grand, 10 to 1, not bad odds. Sometimes CFOs and financial executives can be short-sighted because of cash flow, and they're looking to recapture that return on investment soon, aggressively, 6 months, 12 months, 18 months. And we can't lose sight of the fact that if I'm investing in my people, if I'm training and I'm putting processes and procedures in place, there is a lasting effect on that that's beyond just calendar fiscal years. So case in point, a very underutilized opportunity is footwear programs for workers. Construction, manufacturing, transportation, warehousing, it's all prone to, they're standing on concrete, they're on their feet for long hours of the day. And we view that as that's their responsibility. But anybody who goes out and looks at what people have on their feet in the workplace, it's deplorable. They're wearing equipment that isn't suitable to withstand the strain and the risk of their job every day. So if I'm a CFO and I say, I'm going to invest in footwear for my people, I have $125 footwear allowance for these individuals, and I'm going to change that out every 18 months. If I realistically have an employee that could work for me for 40 years, that's a $3,500 investment in that individual. But the return on investment for a foot injury is $17,500 for one injury. That person could have an injury every year, every other year, every 3 years. On a knee, it's 35,000. On a low back strain, it's 60,000. So we start getting into terms of 5 to 1, 10 to 1, almost 20 to 1 return on investment. But oftentimes they look at it and goes, I'm not spending $125 per individual on a pair of boots. They can pick their own footwear, right? This affects how they work. This affects the comfort level. So the other side of ROI is beyond the financial, it's the organizational return. Do we retain employees because they feel valued? Do they appreciate coming to work because they have the right equipment to do their jobs? Do they feel more fit and capable of doing it? And does that ultimately allow them to work for us for a longer time? And if we're really looking at ROI, are we thinking about turnover costs? Are we thinking about incident investigation costs? Are we thinking about all these other benefits that come from making micro investments in our people? So much like TCOR, we've got to broaden that view, bring all the stakeholders to the table, and see what these investments actually yield versus just, that's going to cost me $125 per person.
Thanks, Jeff. One final question for you, Eric. What would you say is best practices are for identifying financial opportunities, employee impact, and ultimately communication across the organization?
Yeah, so I think again, like you could come back to like, I feel like I'm repeating this a little bit,
Yep.
but it's there's data points in everything that help us identify where the real opportunities are. And I think for the most part, when we walk into newer situations, we're Switzerland in the fact that like we really want to understand what's going on to come to the table and help our clients make effective decisions. So I think best practice is just to be open-minded about what's going on, because healthcare changes a lot. Again, you have to have a plan with not just going to happen this year, but the following year, because no one likes to change what's going on every year. And the more our clients are in tune with why they have something in place, and then how we measure this thing on the back end to drive results for the bottom line, then the more educated they are throughout the whole process. So I'll just keep it at that.
Thanks, Eric.
Yeah.
Appreciate it. One final question for you, Joe. So many external factors out there, obviously, in this day and age, influencing the cost of insurance from year to year, from month to month. Pandemics, supply chain issues, climate matters, geopolitical matters, of course. What strategies could an executive team implement to help insulate the organization from these fluctuations, from these events that are going to continue to likely happen now and into the future.
I think the natural reaction when people see their insurance costs increasing is, they're maybe convinced to take a deductible and assume some more risk, and that's going to lower your premium because we're transferring less risk to a third party in the form of an insurance contract. The problem is it's based on maturity. You need to be able to handle that risk. You have to be prepared to accept that and have systems, controls, and education in place to know what you're up against, right? Otherwise, if you assume the first $5,000 of every claim and you have 10 claims, it's going to quickly erode any savings that you had. So we have to be aware of the fact that, knee-jerk reactions and just trying to take a deductible on when you're not ready is going to be a short-term fix and ultimately maybe cause more pain down the line. But for organizations that are prepared and have made those investments and have had multiple years where they're loss-free, deductibles are a great way for them to reduce their overall costs of insurance, eyes wide open that they are assuming some additional risk. But if they're performing well, that's an acceptable risk to take on. When we're talking about so much market fluctuation and external factors that are truly outside of the control, I have a customer that for the last 25 years, and this is truth, has not had a claim in 25 years on their property. And they're looking at a 5 times increase and a 60% reduction in their capacity. It's very hard to deliver that message, especially for someone who did really well. So when we start to see those market fluctuations and these hard corrections that have come, and that's a result of that loss ratio that we've had, we are trying to take more underwriting into consideration to, build up the reserves again for, every $100 that was taken in, we paid out 102. So, there were some net losses. But as we see these market fluctuations and these external factors, captive insurance programs become a very competitive advantage in this case. And largely because your captive program is based on your losses. And that's the important factor, where so much of the external stuff is somewhat insulated. And I always use the analogy of, if we're in a harbor and the water level rises, all the boats go up, right? But a captive program in some way, shape, or form is similar to like a break wall, that it can kind of keep you somewhat insulated from those up and down changes. Captive insurance programs aren't for everyone. You have to be a certain size, you have to have a certain industry. But for those that are performing well, it provides a very strategic opportunity to, take control of your destiny, so to speak. You become more of an owner of an insurance product than a consumer. And more importantly, you retain so much more control over the claims, which then can impact the overall cost of the claims, as well as, the chance to reap some underwriting profits on the back end, 25 to 30% of what you were paying on your 3 primary lines. If you perform well, could come back to you in the form of working capital. And that does help, weather the storm of the external increases we're seeing.
Well, thank you very much, Joe. And that comes to the end of our podcast. I want to thank our viewers for tuning in. I want to thank Joe, Eric, and Will for the beneficial information that they provided today. This podcast will be available on our social media in short order. And I look forward to seeing all of you at our 3rd installment of this series of podcasts in September of 2023. Thank you very much and have a great day.